Why let your bank pay you pennies when another insured savings account could pay you real dollars for holding the same cash? That is the whole question behind high-yield savings accounts. This is Money Hacks USA, where we make your money work smarter. A high-yield savings account is not a stock, not crypto, not a risky investment, and not a get-rich shortcut. It is usually just a savings account that pays a higher APY than the basic account at a big traditional bank. The difference can look small as a percentage, but on real cash, it matters. If $10,000 earns 0.01%, that is about $1 a year. At 4%, it is about $400 a year before taxes. Same cash, very different result. A high-yield savings account is a place to keep cash while earning interest. The phrase high yield simply means the account pays more than a standard savings account. Many are offered by online banks because they do not have the same branch costs as traditional banks. The important number is APY, which stands for annual percentage yield. APY includes the effect of compounding, so it is more useful than a basic interest rate when comparing accounts. If one account pays 0.01% APY and another pays around 4% APY, the higher yield account is not just a little better. On $5,000, 1 cent percent earns about 50 cents in a year. Around 4% earns about $200 before taxes. That is money you do not get by leaving cash asleep. High-yield savings rates are not fixed forever. They move when banks change their offers, and they often respond to the broader interest rate environment. That means an account paying around 4% today could pay less later, or a competitor could offer more. This is why you should not treat APY like a permanent promise. Think of it as the current price your bank is willing to pay for your deposits. A good habit is checking your rate every few months. You do not need to chase every tiny difference, but if your account drops from around 4% to 2%, while other insured accounts are still near 4%, that is worth noticing. The goal is not constant bank hopping. The goal is not letting inertia quietly cost you interest. High-yield savings accounts are best for money you need safe, liquid, and easy to access. That usually means emergency funds, short-term goals, rent reserves, tax savings, travel funds, wedding money, a car down payment, or cash you plan to use in the next year or two. They are not designed for long-term retirement growth. If you are 30 years old and saving for retirement 30 years from now, a savings account probably will not outpace inflation as well as long-term investments might. But for emergency money, the point is not maximum return. The point is safety and access. If your car needs a $900 repair, you want cash available, not money stuck in a volatile investment that happens to be down that week. Safety matters more than a flashy rate. For most people in the U.S., the key thing to look for is FDIC insurance at a bank or NCUA insurance at a credit union. The standard coverage limit is $250,000 per depositor, per insured institution, per ownership category. That means if your balance is under the limit and the institution is properly insured, your cash has strong federal protection if the bank or credit union fails. Do not just trust a slick app or a high advertised APY. Check that the institution itself is insured, understand whether the account is directly at a bank or through a partner bank, and keep records of where your money is held. A higher rate is nice, but safety is the job. The interest is just the bonus. The best high-yield savings account is not only about the highest APY. Fees and rules can wipe out the benefit. Watch for monthly maintenance fees, minimum balance requirements, withdrawal limits, transfer delays, and whether the rate only applies up to a small balance. For example, an account advertising 5% APY, but only on the first $500 is not as useful for a $15,000 emergency fund as a 4% account on the full balance. Also, check how easy it is to move money back to your checking account. Some transfers take 1 to 3 business days. That is usually fine for planned expenses, but for true emergencies, some people keep a small buffer in regular checking and the rest in high-yield savings. Convenience has value too. The power of a high-yield savings account becomes obvious when you use real dollars. Say you keep a $12,000 emergency fund. In a basic account paying 0.01% APY, you earn about $1.20 in a year. That is basically nothing. In an account paying around 4% APY, you earn about $480 before taxes. Over 2 years, if the rate stayed similar, that could be close to $960 before taxes. You did not invest in the stock market. You did not lock the money away for 5 years. You just moved idle cash to a better parking spot. That is why this is one of the cleanest money upgrades. It does not require cutting your budget, working overtime, or changing your lifestyle. You are simply making your cash more productive. Here is the simple version. A high-yield savings account is a safer cash account that usually pays much more than a basic savings account. Use it for emergency funds and short-term goals, not money you need to grow aggressively for decades. Compare APY, but also check insurance, fees, minimums, balance limits, and transfer speed. A few percentage points can turn $10,000 from about $1 a year into hundreds of dollars a year before taxes. That is not magic. It is just better cash management. Subscribe to Money Hacks USA for more practical money tips that help you keep more of what you earn. The free tools and resources linked in the description support the channel at no extra cost to you. Do not save what is left after spending. Spend what is left after saving. Warren Buffett.